To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
Hello friends, my name is Sriram and I am your faculty for Paper 2 Strategic Financial Management SFM. So friends, let us look at the next question. KMPS Limited wants to purchase BRB Limited. BRB is another company, KMPS is the acquirer and BRB is the target, by exchanging 0.7 of its shares for each share of BRB. So, 1 share of BRB is equal to 0.7 shares of KMPS, which is the acquirer. Relevant financial data is as follows. Outstanding shares is 20 lakhs and 8 lakhs, EPS is 40 and 28 and market price per share is 250 and 160. Okay, so you divide market price by EPS, you will get the PE. Okay, we'll come there. I don't think we need to right away do work for it. Let us see. Illustrate the impact of merger on EPS of both the companies. So, what is going to happen to EPS of both the companies, we should figure out. This is fairly simple, we have done multiple questions like this. The management of Mrs. BRB has quoted share exchange rate of 1:1 for the merger. That is, for every share of BRB, they want 1 share of KMPS. Now, this is the quote by BRB. Earlier, KMPS said they want to do it at 0.7 for every 1. Okay, so this is slightly different. That is the second alternative. Assuming that P/E ratio of KMPS will remain unchanged after the merger, what will be the gain from the merger for BRB? So, we have to compute the revised EPS, compute the revised share price. Because it is 1:1, old share price versus new share price, that is BRB's old share price versus KPMS new share price. Right, both of them you compare, you directly know whether there is any gain or loss. For BRB, we will figure that out. Find out the gain or loss to shareholders of KMPS if the exchange ratio is 1:1. So, because of this, is there any gain or loss to shareholders of KPMS? That also has to be found out, and determine the maximum exchange ratio acceptable to shareholders of KPMS. Now, here what will you do? What is the maximum exchange ratio? The maximum exchange ratio will be computed in such a way such that they don't lose out, right? That is, their price does not come down. See, now here if you see KPMS, one place they have said KMPS, one place KPMS, what people here? See, KPMS and here they have said KMPS. Anyway, so let us say whatever it is K, right? Now the acquirer, share price is 250, target share price is 160. Let us say with 1:1 ratio, the share price, given the 1:1 share exchange ratio, the EPS changes and all of that. Let us say the KMPS share price falls to 180, right? Now, even if it is 180, it is good deal for BRB, but it is a bad deal for KMPS, right? So, we have to figure out at what ratio or what exchange ratio will the price not fall further. Will the price not fall further? And how will you determine the price? Using the PE ratio and the combined EPS. It's a fairly simple problem, nothing complex, and this is from when? This is December 21 new syllabus question. It's a fairly simple one. Let's go ahead and solve this. So friends, let's go ahead and solve this particular question. So I don't know whether it is KMPS, KPMS. I'll just say KMPS. Okay. So particulars. I think we don't need such a wide column. Computation, KMPS, then BRB. What is the first one? Outstanding shares, 20 lakhs, 20, 1, 2, 3, 4, 5 and 8 lakhs, 8, 1, 2, 3, 4, 5. Oh, I have written it in the wrong column. This is given. Okay. This is outstanding shares. Then EPS in rupees is also given, which is how much? 40 and 28. 40 and 28. Right. Then you have shares and EPS. What you will get? PAT in rupees is EPS into share count. So 20 lakhs into 40, which is 8 crores, and this is 2.24 crores. Okay, 28 into 8 lakhs is 2.24. PAT we have computed. Then market price per share in rupees. It is given. How much is the market price? 250 and 160. So PE ratio. PE ratio is equal to market price by EPS, which is 250 divided by 40, which makes it 6.25, and the other one is 5.71. 5.71. Right. Now, illustrate the impact of on EPS of both the companies. Right. So, now first question is illustrate the impact of merger on EPS of both the companies. What is the and it at what ratio? It is 0.7:1, right. So, swap ratio 0.7:1, right. So, shares of KMPS issued to shareholders of BRB at 0.7:1. This will be how much? Your 8 lakhs into 0.7. For every share you are issuing 0.7, no? So 5,60,000 is the shares that are issued. 5,60,000 shares are issued, right. So impact of EPS on both the companies. Okay. So revised share count of KMPS post merger. What is it? Your 20 lakhs plus 5,60,000. Now post merger EPS or post merger PAT of KMPS is, we already have computed PAT individually, no? So let me add both the PATs. So I will say here combined, right. So 8 crores plus 2.24 crores is 10.24. So this 10.24 crores is the post merger PAT of KMPS in rupees. Then share count of KMPS is also we have computed 25.6 lakhs. So revised EPS in rupees is how much? 10.24 divided by 25.6, which is 40. Oh, so they have got an EPS of 40. What was 40 here? So the EPS is not changing. The EPS of KMPS is not changing. It is same at 40. So this exchange ratio looks ideal. Why? Why? Because what is the ratio of EPS? 40:28. That is, if you divide by 4 times, it is 10:7 or 1:0.7. So when you issue shares which are inverse of the ratio of the EPS, which is 0.7:1, the revised EPS of the post-merged entity or the post-merger EPS will actually not change. Why? Because the exchange has happened at the appropriate ratio. Okay, which is the revised illustrated impact of merger on EPS of both the companies. So revised EPS in rupees of KMPS. So this is 40. Now will there be any impact of this on the EPS of BRB? There is no impact on EPS, or we can say equivalent EPS of KMPS for shareholders of BRB is how much? See, 40 rupees is the EPS, but have you got one share for every one share that you held? No, you got 0.7 shares. So this is 40 into 0.7, right? Equivalent EPS is basically 28 rupees, right? So no impact. There is no impact on EPS post merger on shareholders of KMPS or BRB, as the swap ratio is in the ratio of, or is in line with the ratio of EPS of both the companies. Correct? Okay, so if I am not wrong, we have solved a very similar problem, or probably I think the same problem earlier, but it had different names. But because this is, exam question, I thought I should solve it again. So I don't see any harm in solving it again. Okay. Now come to part 2. What is part 2? The management of BRB has quoted an exchange ratio of 1:1. Assuming that the PE ratio of KMPS will remain unchanged after the merger, what will be the gain from merger to shareholder for Messrs BRB? So revised swap ratio proposed by BRB guys is 1:1, right. So shares allotted based on this swap ratio is how much? For every 8 lakhs you will get 1:1, you will get 8 lakhs. So total new shares, total share count post merger of KMPS is equal to 8 lakhs plus your 20 lakhs, which is 28 lakhs, right? So actually I'll put these both here, or I can put them here also. Okay, then what did they say? What will be the gain from merger to BRB? Now, assuming the PE ratio of KMPS remains unchanged. So, post merger PAT in rupees, how much we've already computed, or yeah, we've already computed 10 crores, 24 lakhs. So, post merger EPS in rupees is how much? 10.24 crores divided by 28 lakhs. So, we are computing the revised EPS, right? So, this is 36.57, right? Now, post merger PE. What is the PE? Assuming same as KMPS pre-merger, which is how much? 6.25. So, post merger market price in rupees of KMPS is 36.57 into 6.25, it comes to 228. What was the price earlier? 250 and 160. See, this is what I was saying. Equivalent value per share of what is the BRB is same to 228.57 or at swap ratio. At swap ratio 1:1 is same 228. So, pre-merger share price of BRB is how much? 160, right? See, so gain made by shareholders of BRB per share in rupees is difference between these two is this much. Total gain made by shareholders of BRB in rupees is per share they have made 68.57. How many shares do they have? They have 8 lakh shares. So, you multiply by that. So, they made an overall gain of how much? 5 crores 48 lakh 57,143. Okay. So, this is they have made a decent amount of gain. They made a good amount of gain. Is that the question? Yes. They have asked what, assuming PE ratio of KMPS will remain unchanged after the merger, what will be the gain to the merger for Mrs. BRB Limited? The gain for merger is per share it is 68 rupees, or on total the gain made by all the shareholders is 5 crores 48 lakhs. Then what is the gain or loss to shareholders of KMPS? This is very simple, no? Part 3, pre-merger share price in rupees is how much? 250, right? Share price of KMPS in rupees, post merger share price in rupees is how much? 228.57. These are the same exchange ratio, right? So, loss per share for shareholder of KMPS is 228 minus 250, which is 21.43. Okay, this is the loss per share in rupees. Total shares of KMPS in numbers. Total loss in rupees for all shareholders of KMPS. Okay, what is the total shares pre-merger? Pre-merger is 20 lakhs. So, on this 20 lakhs, they have lost 20 lakh shares. Each share they have lost 21 rupees 43 paisa. So, the total loss by them or for them actually is 4 crores 28 lakhs 57,000. For them, the loss is 4 crores 28 lakhs 57,000. Okay, you can give it on a per share basis, or you can give it on a overall value basis also. Now, what is the last one? Determine the maximum exchange ratio acceptable to shareholders of KMPS Limited. Determine the maximum exchange ratio acceptable to shareholders of KMPS Limited, not for BRB. Okay, determine the maximum exchange ratio. What is the exchange ratio at which they are most happy? If their share price doesn't go down, they are most happy. At what point will their share price not go down? If their EPS is supposed to be, if their PE ratio is supposed to be 6.25, at what EPS will the market price remain same at 250? When will they be, what is the maximum ratio they can offer, or that is what is the least benefit that they can get? 0 rupees, right? Any benefit below 0, they are at loss. So at the most they will say, chalo, I don't want any benefit. That is, their share price doesn't come down. If their share price should not come down, at what price will it not come down? It will not come down at existing share price of 250. How, and assuming that their PE ratio remains the same at 6.25, which is pre-merger ratio, at what EPS will their price be 250 when PE ratio is 6.25? Same 40. When will their combined EPS be 40? We already computed it in the first point. Revised EPS in rupees of KMPS is 40 when the swap ratio is 0.7:1. That is, for every 1 share, if you allot 0.7 shares, then you will, these guys, the KMPS guys will not be losing out. So, the answer for this last part 4. The shareholders of KMPS will not lose out if market price remains at rupees 250 and PE at 6.25 times. This implies post-merger EPS should be 250 by 6.25, that is rupees 40, right? Correct. Now, post-merger EPS is at rupees 40 when swap ratio is 0.7 shares of KMPS for every share of BRB, right? As per part 1, as we have already computed in part 1. So, let me write that as already computed in part 1, right? Post-merger EPS at 40. So, ideal exchange rate or maximum exchange rate is 0.7:1. Okay. So, this is the answer for this particular question. I think the question that we solved earlier probably had a very, slightly different twist to it. This has a very different question that was asked probably. But anyway, it's a fairly simple one, just that you have to keep applying your mind as to what is happening and then be careful as to what you're doing. Okay, let us move to the next problem. So friends, now let us look at the next question. Long Limited is planning to acquire TAL. So Long is acquirer and this is TAL is target. With the following data available for both the companies. Expected EPS 12 and 5, DPS 10 and 3, DPS means dividend per share. Number of shares 30 lakhs and 18 lakhs. Current market price of share is rupees 180 and rupees 50. We can compute PE, we can compute bunch of other things, the market cap and all of that. As per an estimate, TAL Limited is expected to have steady growth of earnings and dividends to the tune of 6% per annum. So, this company is supposed to have 6% per annum growth independently. However, under the new management, growth rate is likely to be enhanced to 8%. So, 6% without merger, 8% with merger. Right. The growth rate of earnings and dividends is same. Calculate the net cost of acquisition by Long Limited if rupees 60 is paid for each share of TAL. That is the net cost. Okay. Please note. Then, if the exchange ratio agreed is 1 share of Long for every 3 shares of TAL, in lieu of cash, that is instead of doing cash, if they do a share swap arrangement, then what will be the net cost of acquisition? So, what will be the net cost of acquisition? Okay. Calculate the gain from acquisition. What is the gain from acquisition? Now, this is from a July 21 new syllabus question. It's a fairly interesting one. I think we have solved 1 or 2 questions like this. Let us solve this. I have 1 or 2 small issues in the way the question is structured. I will explain to you what my issues are and then, I will, give you my alternative way of looking at it also. Okay. So, let's go ahead and solve this problem. So, friends, let's write down the data as I had mentioned earlier. First, just write down the existing data. It will solve a bunch of issues. Amount in rupees. Long, who is the acquirer, and TAL, who is the target. Right. Expected EPS. So, you can call it as E1. Okay. E1 is 12 and 5. Then expected EPS D1 is 10 and 3. Then number of shares. Shares outstanding number is 30 lakhs 1, 2, 3, 4, 5 and 18 lakhs 18 1, 2, 3, 4, 5. Okay, shares outstanding. Then current market price. This current market price is 180. All of these are rupees. Okay, 180 and 50, not 150 and just 50. So, from this what can be computed? PAT in rupees can be computed. Then dividend in rupees can be computed. Shares outstanding is there, current market price, market cap in rupees can also be computed. What is PAT? So, I will add a column here. PAT is EPS into share count, and PAT expected, both of these are expected, right. Dividend also DPS into share count. Market cap is price into share count, and we can also compute the PE ratio, which is price divided by EPS, right. So, let us see what all we have. EPS into share count, EPS into share count. So, and let me put this also in decimals, right. This is 3.6 crores is the PAT of Long Limited, and for Tall Limited, I will just copy this, it is 90 lakhs. 90 lakhs is the PAT, that is 5 rupees of expected EPS multiplied by 18 lakhs is 90 lakhs. Dividend is 10 into 30 lakhs, which is 3 crores. Same way it is 3 into 18 lakhs, which is 5.4 crores, which is, sorry, 54 lakhs, not 5.4 crores, 54 lakhs. Then market cap. Market cap is what? Price, current market price into share count, right. This is 54 crores, 7 zeros, right. Yeah, 54 crores for one, and for the other it is 9 crores. How is it 9 crores? 50 into 18 lakh shares, right. Then PE ratio. PE ratio is price by EPS. So, 180 divided by 12, which is 15, and in the other case it is 10. So, there is again a multiple arbitrage. Okay, so we have first computed the data based on this. As per estimate, Tall Limited is expected to have a steady growth of earnings and dividend of 6%. So, G1 old and G1 new, or I will say pre-merger, post-merger. Why old, new? Pre-merger and G1 post-merger only for Tall, right, is 8% and 6%. And let me also make a column of total here, which is PAT is summation of these two, then dividend is summation of these two, market cap is summation of these two. Dividend I don't think is required, but anyway I have given it out, right. So, G1 post merger also is written. Now, calculate the net cost of acquisition by Long Limited if rupees 60 is paid for each share. See part 1, net cost of acquisition. Okay, so this is, I told you, right, I have some issue with the nomenclature or language that is used. What is net cost of acquisition? Generally, net, when you talk in net in accounting terms, when you talk net in income tax terms, net means your gross minus some adjustment basically gives you net. Cost of acquisition, gross cost of acquisition less any number will basically give you net cost, right. Now, when you are looking at net cost, when you are subtracting a number, cost minus some number is net, right. Gross minus some number is net, right. What is that some number? That some number ideally should be savings, right. Number should ideally should be savings. So, gross minus savings or some kind of synergy is equal to net. So, what is the amount that you paid versus the benefit that you got is the net payment or net cost. Cost of amount paid minus the benefit that you got, the balance is basically the net cost, right. So, here when you talk of net cost of acquisition, here they specifically said what? Calculate net cost of acquisition if rupees 60 is paid for each share of Tall, right. So, first let us find out the cost, gross cost of acquisition. Cost of acquisition is price per share into shares or share count, right. What is price per share? They said 60 rupees, right. 60 into number of shares. How many shares are there? Into 18 lakhs, 18 lakh shares. So, this is gross cost. So, till here there is no problem, and we will give this in rupee terms. So, this will be 18 lakhs into 60, which is how much? Which is 10.8 crores. Gross cost of acquisition is 10.8 crores. So far so good. Now, what should you subtract from this? When you do NPV also, you say total inflows and total outflows, and then you subtract one from the other, and then you get either the net inflow or net outflow, whatever you do. Same way, this is the cost. What are you getting in return for this? What are you getting in return for this? So, here, according to me, you should value the company based on the post-merger value of the business, and then subtract that from the cost of acquisition and get the net value. Whereas, if you look at the material answer what they have given, they have subtracted the current market price or they have subtracted the current market cap. So, I will show you what they have done. Less current market cap. Current market cap. How much? What is current market cap of these people? 9 crores. Right. So, net cost of acquisition. So, they have said that net cost of acquisition is these two, difference between these two, which is 1.8 crores. Okay. This is the answer that is given in the material. I don't think that is correct. Okay. So, I will say here method 1. This is what is given in the material or suggested answer, but I disagree with this method. Because when you do gross and net, you have to take gross being the cost of acquisition, so far so good. Net should be either synergy or value of the company. You cannot take necessarily the market cap. Right. So, here I will say current market or pre-merger market cap. Right. So, this I don't think is correct. What I will do is gross cost of acquisition, I will consider the same numbers. Net is where I have a difference of opinion. Right. Less value of business acquired. Value of business acquired. This is a gross cost. This is 10.8 crores. Value of business acquired. See, you can argue that value of business acquired is, necessarily the current market price, right? But when you are computing a cost of acquisition, you do it for basically from the purpose of, what is the, value that is attributable to me, or what is it that I am getting, right? Or what is the benefit I am getting, or what is the inflow I am getting. You don't compare it with the another market value. So, this one I will call this as working note 1. Okay, so now let us compute the value of business acquired as per working note 1. Right. Now, calculate the net cost of acquisition if rupees so and so is paid. Now, do you value the business pre-merger or post-merger? See, there is an expected increase in the value of the business because it is coming to them. Right. So, because it is coming to them, do you value based on the post-merger, post-integrated, whatever synergies are coming? Do you value including that, or you exclude those values and say, nahi boss, when I acquired, this is the value. I acquired, I believe this is the value. Okay, which one do you do? So, calculate the net cost of acquisition by Long Limited with 60 rupees paid for each of Tall Limited. Right, so, they have not given any specific data point here. So, I think we should compute both the values and then we will see which one we will apply. Okay, value per share. Okay, per share of Tall, pre-merger, post-merger, right, or pre-merger including post-merger benefits. Right. So, here how do? You do the dividend discount model. Now, for you to do the dividend discount model, current market price is given this much, yeah. So, what is P0? P0 in both the cases is, in this case is 50. Okay. Then, let me remove this 50 here. First, let us compute as per pre-merger, then we will see. Then, D1 is how much? D1 is 3. Okay. Then, G is how much? G is 6%. So, KE can be found out. What is the KE? KE is D1 by price is D1 by KE minus G. If you cross multiply and take things other side, what you will get is KE is equal to, or P0 is equal to D1 by KE minus G. And if you do cross multiply and take things other side, KE is equal to G plus D1 by P0, right. So, KE, here I write P0. So, price 0 is 50 and KE is, what is KE? If you work backwards, G, what is G? 6% plus D1, which is 3, divided by P0, which is 50, right. So, if you simplify this, you will basically get KE is equal to 12%, right. KE is equal to 12%. Now, this 12%, using this, do we compute the post-merger value? Can we compute the post-merger value? Yes. P0 post-merger. D1, then KE, then G. What is D1? See, post-merger next year expected DPS will change, no? Under new management, growth rate is likely to enhance without any additional investment. So, here D1 is 3 and the growth rate is 6. right? So, do you compute D0 and then work on this for the next year? Ideally, that should be the way. So, you compute D0. D0 is equal to D1 divided by 1 plus G, right, which is 3 by 1 plus 6%, right. So, it is 2.830. So, here what is D0? D0 is equal to 2.830, right. What is G? G is 8%, correct. D1 is D0 into 1 plus G, which is 2.83 into 1 plus 8%, right. This comes to 3.06. Then KE is computed above, which is 12%. G we have already taken. So, P0 revised is how much? You use the formula P0 is equal to D1 by KE minus G. This will be D1. What is D1? 3.06 divided by KE 12% minus G, which is 8%, right. So, it is 76.5. What was it earlier? It was 50 rupees. It has gone up to 76.5. Now you see friends, why have I done all of this exercise and tried to find out this revised price and all of that? Because I believe here, value of business acquired. This I am assuming this is value post the merger. If you consider value pre-merger, so net cost of acquisition method 1, value of TOL pre-merger, here you can say value of TOL post merger. See, here also if you take same 50 rupees, no, 50 rupees which is the value that is given here, then it is same as method 1. What is this whole method 2 all about? Value of business acquired as per method 2 is basically you are trying to compute the value post the merger, right. So, given this is the case, P0 revised market cap or value of TOL is P0 into shares outstanding. What is it? Actually, I think I should put all of this in column for TOL. No, that's okay. Right. P0 into shares outstanding, that is 76.5 into what are the shares outstanding? Here are the shares outstanding count here. So, you get 13.77 crores. So, value of business acquired is 13.77. Now, if you consider this net cost of acquisition, if so and so is paid, it is actually coming negative. So, this is coming negative. So, basically, if you go by this method, right, where you are paying 13.77 crores, net cost of acquisition in rupees is a negative number. You see the difference it makes of words, language, how much difference it makes, the right kind of language that you use. So, here in the question, if we assume that the acquisition is as per what? What is the specific? Calculate the net cost of acquisition of long if so and so is paid. Okay, if they had given a word, net cost of acquisition considering the pre-acquisition value, no, then this is the correct answer. If they did not say that, then the net cost of acquisition is negative number. Why? Because there is a value to the inherent value to the business, you have to subtract that value rather than the pre-acquisition cost. Okay, so some of you may choose to, ignore this second part saying that, it is unnecessarily complicated, but I actually think, the language that is used is not clear enough, which is why I have chosen a method like this. Okay, now let us come to the second part, part 2. What is part 2? Part 2, instead of having a cash payment, they are doing a exchange ratio of share swap. Share swap of 1 share of long for 3 shares of TOL. That's what they said, right? What will be the net cost of acquisition? So, if you do this as 1 share of long for 3 shares of TOL, then what will be the net cost of acquisition? So, here you have computed gross cost of acquisition in by directly considering the value per share. Now, instead of considering the per share cash paid, you have to consider the swap ratio and existing price of shares of long limited have to be considered. That's all. There is no other change. Only the first line item changes. The second 2 line items do not change. right? Second two line items do not change. Why? Because they said in lieu of cash, if you give shares, then the value of the business is going to remain the same. The value of the business is not changing, but the amount that you have paid is changing, right? The amount that you have paid is changing. Okay, so let's go ahead and do that. So share swap of 1 share of long for 3 shares of tall. Right, 1 share of long for 3 shares of tall. So here you may ask me a question, this 1 share of long, should we take current market price or should we take the post-merger benefit, whatever is occurring? No, here according to me, you should take only the current market price because this is what you are giving in return. Today the value is this, right? Today the value is this. So price per share of long 180, number of shares of tall is how much? 18 lakhs, right? Shares issued at swap ratio of 1 for 3 is 18 lakhs divided by 3 into 1, which is 6 lakhs. Total value of shares issued at current market price is how much? 180 is price per share into 6, which is 10.8 crores, right? Or it is 108 crores, 1 minute. It is 10 crores 80 lakhs. This comes to very similar to the previous working. 10 crores 80 lakhs, right? 10 crores 80 lakhs is the exact value what you've got there. Yes, so you've got 10 crores 80 lakhs is the value. So even in this case, you'll get the same answer. Whether you pay it in cash or whether you pay it through exchange of shares, you're going to get the same value. So total value of shares. So gross consideration in rupees is 10 crores 80 lakhs. So now method 1, net consideration. Assuming current market price of tall, right? So gross consideration less market price, market cap of tall, net consideration when shares are swapped. So this is 10.8 crores, market cap is same 90 lakhs, we've already computed it, we need not recompute anything, right? So net consideration is sum of these two. Then method 2, net consideration considering after computing value of tall post merger. Okay, gross consideration is here less value of tall post merger. This we have already computed here. Gross consideration is 10.8 crores. Net consideration we have already computed here. Where is it? 13 point value of business acquired as per working note 1. So I can say working note 1, right? 13.77. So if you subtract one from the other, or rather actually put minus here, yeah. So net consideration is 2.97. We've got the same answer earlier also, no? 2.97, same thing. Yeah, obviously you'll get the same thing, no? Because you have not made any changes to the gross consideration. So gross consideration is exactly same 10.8 crores. Here also it is same 10.8 crores. So obviously there is no change. So there is no change. Okay. So now let us come to the last part, calculation of gain from acquisition. So friends, come to part 3, which is calculation of gain from acquisition. Now this gain is EPS gain for the business. What is the specific language they used? Calculate the gain from acquisition. Now when you say gain from acquisition, is it for the acquirer or is it for the target? Is it at what price? Whether is it at cash or whether is it at share swap? See, whether it is at cash or share swap, it doesn't matter because the consideration paid is same. But they may have a very different impact. If it is on cash, you'll actually have cash outgo, because of which you'll have to pay interest. You'll probably reduce interest income, or you'll have to pay any interest expense, but they have not given that, right? They've not, you're understanding what I'm saying, right? So if let us say long is acquired tall by paying cash, so cash goes away from balance sheet of long, then interest income will come down, or they have to borrow some money and make payment in cash. So then interest expense will come. So either income will go down or expense will come, either ways the EPS will come down, but that will be multiplied with a different PE ratio, right? What is the PE ratio here? PE ratio, where we computed? Yeah, 15. Right, so that is one way. right. Second thing is for the target. Target, irrespective of what it is, what they have been paid, right? So, they are paid same 50 rupees per share, or what was that? So, they are paid 60 rupees per share if it is cash payment, and if it is a share swap also, they are valuing it at 60 rupees. So, for them, compared to current market price of 50, that is incremental value. You can give per share also, you can give overall also. Okay. So, let us compute for both of them. They have not said for whom gain. Very unfair way of asking question according to me. So, let us compute for both of them and compute over on an EPS basis as well as overall value basis. Okay. So, let us do that. Calculation of gain from acquisition. First, we will do this for long limited. Okay. And first, we will do EPS gain. Okay, we have not been given the interest cost, so we will not consider that as the, it is happening as per cash. We will consider as if it is happening by share swap. EPS gain in case of share swap. Okay, let me first write, in case of cash payment cannot be computed as impact on interest income stroke expense is not available. Okay. So, EPS gain only in case of share swap can be computed. Okay. So, now expected EPS also again will grow, right? EPS will not remain the same, because why? They said that the overall earnings are likely to go. Okay. So, pre-merger PAT in rupees. What is pre-merger PAT? For long limited, we have computed the PAT somewhere here. Where is the PAT? 3.6 crores. And for tall limited, it is how much? 90 lakhs. Right. Now, this is next year's PAT. Right. This is next year's PAT. Pre-merger PAT in rupees in period 1. Right. Now, because of the merger, don't you think EPS will go up? Yes, obviously, EPS will go up. So, pre-merger PAT in rupees in period 0. This is grown by 6%. So, divide by 1.06. E1 by 1 plus G. Right. This is E0. Let me call this as PAT 1. PAT 1 by 1 plus G. Okay. Right. So, then PAT 1 post merger in rupees is PAT 0 into 1 plus revised G. So, this is 8490566 into 1 plus 8%. Why? Because it is expected to grow to 8%. So, there is an increase in PAT. Okay, this is the first aspect. Now, for long limited, there is no change. All this change is only in tall limited. Okay, let me put it here. Yeah. So, for tall limited, it is same. Okay. So, combined, let me not write PAT, combined. What is combined PAT? This plus this, which is basically 3.6 crores plus 91 lakhs is basically 4.51 crores. Right. Now, this is PAT. Now, we are looking at PAT, share count. We are doing it as per EPS, right? Share count. Share count is how much? Share count is existing and this is share swap. So, how many shares are issued? Shares issued is 6 lakhs. So, share count existing long, share count new issued tall, share count total. Right. What is the existing share count? We have existing share count of 30 lakhs. New shares issued to tall is 6 lakhs. So, total is 36 lakhs. Right. Share count total. Revised or post merger EPS is PAT by share count, which is 4.51 crores divided by 36 lakhs, which is 12 rupees 55 paisa. What was it earlier? It was 12 rupees. It has gone up to 12 rupees 55 paisa. So, post merger EPS has gone up to 12 rupees 55 paisa. Right. Now, this is share swap. Right. So, and we are first doing for long limited, right? So, long limited shareholders EPS has gone up from rupees 12 to rupees 12.55, right? Increase of 0.55 of rupees 0.55, which works to how much percentage? 12.55 divided by 12 minus 1 works to a growth of 4.56%. Okay, this is the first aspect. Then impact on equivalent EPS. Equivalent EPS for shareholders of TAL. What is it? Swap ratio is for every 3, 1. So, revised EPS or post-merger EPS, equivalent EPS at swap ratio of 1 for 3 is basically simply dividing this by 3. By 3 into 1 is basically this. So, it is 4.18. Pre-merger EPS of TAL is how much? We have computed that also here somewhere. EPS is 5. Oh, so reduction in EPS for TAL shareholders. How much is equal to 4.18 by 5 minus 1, which is 15% reduction. So, you see somebody is gaining, somebody is losing. On EPS side, this is what has happened. Now, market, let us come to market value. Market value stroke share price. Okay, first shareholders of long, right? What is revised EPS is how much? We computed it here, no? 12.55. Then new PE, assuming same PE continues. Let me not call it new PE, just say PE. Assuming same PE continues. What is the PE? 15, right? Yeah, 15, right? So, revised market price is multiplication of these two, which is 188.20. That is market price in rupees, right? Pre-merger market price is how much? Is 180. So, increase in market price in rupees is how much? Difference between these two, it is 8 rupees. Increase in market price in percentage is 8.2 by 180, which is basically 4.56%. Right. Now, this is increase in market price. Number of shares held by old shareholders of long is how much? 30 lakhs. Increase in market value for shareholders of long is increase in market price into share count, right? So, this is 30 lakhs into 8 rupees per share what they have got, which is basically will give them 2 crores 46 lakhs 22,000. So, you see how many ways to evaluate the same question. When they give a question without clarity as to what is to be done, this is what will happen. So, it is very, very important that questions have to be given clearly. Otherwise, according to me, you have to give answers which are super clear, like this is what we are going to do. In fact, if you look at the solution that is given, they have not even considered the impact of increase in growth rate. I think that is unfair, because we have already got the data of D1 and we know what is G1 and G2. So, then you should consider it, no? That is logical, right? Okay. So, next, impact on shareholders of TAL. Pre-merger share price is how much? 50 rupees. Post-merger equivalent share price is post-merger price into swap ratio. That is, what is post-merger price? you got 188, and what is the swap ratio? For every 3 you got 1. So divided by 3. So you basically got it at 62 rupees is what you've got, right? So increase in value per share in rupees is 62.74 minus 50, which is 12.74. Okay, this is the increase they've got. So earlier when you looked at it from an EPS perspective, right, they lost out. Why? They got their EPS came down by 16.4%. But when you look at it from a per share value perspective, the per share value has increased by 12.74. Then increase in value in total market value. Total market value is per share value into number of shares, which is 12.74 into how many shares did they have, which they swapped out? They had 18 lakh shares, right, into 18 lakh shares. So this will be 12.74 into, multiply it with simply 18 lakhs. Right, so you get increase in market value in rupees, okay, is this. Is how much? Is 2.29 crores. So increase in market value in rupees for shareholders of TAL is 2.29 crores. Okay, increase in value is this much for shareholders of TAL. Now, if you look at the material answer what they have given, they have computed, what is the value of long limited after acquisition, which basically, this 18.21 is the share price multiplied by the total number of revised shares, which is which is, we have the share count somewhere, no? Here. So, which came to some 67 crores. And pre-merger price. What is the pre-merger price? So, pre-merger price is just summation of both of them, right? So, I will show you what they have done. Okay, so then you will understand what exactly how they have solved, but I don't think that is the right way. I think this is the right way. You have to show it on EPS side, value side, both for the target as well as for the acquirer. I will just show you what is it that they have exactly done so that you understand that way also. So, gain from acquisition method 3, right, which is what has been given in the material. There also again they have not considered the increase in earnings of the second acquired target, which is TAL Limited post merger. They said that the growth rate will increase from 6 to 8. No, that has not been considered. But anyway, I will show you what they have done. Right, pre-merger market cap. Okay, so pre-merger market cap, we have already computed it. Okay, where is it? 54 crores, 9 crores. The total is summation of these two, which is 63 crores. Okay. Post merger EPS, we have computed it as, where is our EPS? Post merger EPS 4.18, PAT post merger. We have taken PAT post merger as 4.5169 crores. They have not done that. What they have done is post merger PAT. Let me take post merger PAT without incremental earnings, then with incremental earnings. Okay, what is post-merger PAT without incremental earnings? Is basically this 3.6 crores plus 90 lakhs, which basically makes it 4.5 crores. If you take it with earnings, we have already computed it as 4.5169 crores. Okay, so PE applicable, right, is 15 times. Okay, so post-merger value of company without incremental earnings is basically PE into PAT, right, and company with, first one is without, right, so the second one is without incremental, with incremental. So without is 4 crores 50 lakhs into 15, and the second one is 4 crores 51 lakhs into 15, right, and finally net gain or gain from the acquisition, that is what is they said, right? Gain from acquisition is without incremental earnings and with incremental earnings. 67.5 crores minus 6.3 crores and 67.75 crores minus 6.3 crores. So, they have given this 4.5 crores as the answer. Okay, now gain from the earnings, is that what we compute? We have done so many problems. We have done so many problems in which we have computed gain from earnings to either party. If you want to actually gain from earnings, if you want to compute this as 4.5 crores, you should say what is the increase in market value. What is the increase in market value, post the combination of both the firms. If that is to be given, they shouldn't have given that increased growth rate. So, I think the question is very unfair, very poor way of asking. I believe the solution I have done where, when I have given gain from earnings both from EPS perspective, market value perspective, share price perspective, that is a far more, appropriate way. But unfortunately, the institute has given it in this way. The choice is yours, but I would go with the way that I have done. Okay, fair enough. Very small question, but a long answer with multiple variations. Unfortunately, that is the case it is. Okay, let's move to the next one. So friends, now let us look at the next question. This is from November 20 new syllabus. ICL Limited is proposing to take over SVL Limited. An objective to diversify. Okay, ICL's PAT has grown at 18% per annum and SVL's PAT has grown 15% per annum. Okay, that is a past growth rate. Both has grown. They have said has grown, which is why I am saying past growth rate. Both the companies pay dividend regularly. The summarized profit and loss account of both the companies are as follows. Net sales, then you have PBT, interest, then tax, then PAT, then dividends. For both of them, you have the details. Then ICL and SVL, they have given some balance sheet data. Fixed assets, land and building, plant and machinery, furniture and fixtures, total 1650. Then you have current assets 775. Then you have all current liabilities. So, you have net assets of 1955 for ICL and 890 for SVL. Then you have paid up share capital, reserves, then borrowings. Total, capital employed is 1955 and 890. Okay, so balance sheet matches. And market price per share is 52 rupees and 75 rupees for each of them respectively. Now, ICL's land and buildings are stated at current prices. So, they are stated at current prices, no revaluation. SVL land and buildings are revalued 3 years ago. Achha, so they were revalued. And there has been an increase of 30% year in value of land and buildings from there on. Okay, so they have missed a keyword from there on. So, even though it is revalued, that information is irrelevant to us. Okay, it's a googly information saying that it is revalued. What is irrelevant to us is 3 years ago, the price or rather the value of land and buildings, not price, the value of land and buildings of SVL, which is I think 190, what is the currency here? Have they said anything about the currency? Kya rupees crores. It is 190 crores. That was last valued 3 years ago, and from then on, there has been a 30% increase per year. So, 30% increase year on year in the value. So, basically you have to take the value of land appearing on balance sheet and do it multiply it 1.3 power 3. Okay. Then SVL is expected to grow 18% per year after merger. ICL's management wants to determine the premium on the shares of the current market price which can be paid on the acquisition of SVL. We are required to determine the premium using 1. Net worth adjusted for current value of land and buildings, that is net worth, adjusted net worth, plus estimated average profit for the next 5 years. Okay. So, you are just adding the estimated average profit for the next 5 years. It is average profit. Okay. Please note that. Then dividend growth formula. You are required to compute the premium using the dividend growth formula. And then the last one is ICL will push forward which method during the course of negotiations. That is, which method is favorable to ICL or which method is more beneficial to ICL. They have also given the future value based on 30% and 15%. Let us see which one is relevant, which one is not relevant. They have given future value and they are not given present value. Okay, so that is another weird thing. Here average profit after PAT for the next 5 years. So, it is slightly weird. We will come to this first part when we reach there. Okay, and this is from November 20 new syllabus as I mentioned. Right, so let us see, let us start solving because first thing what we need to do is compute the net worth adjusted for current value of land. And then we can come to what do they mean by this average profit after tax for next 5 years and all of that. We will come to that. Okay. So, let us proceed, right. So, friends, let us start off the question or rather the solution to this particular question. What is it that we are required to do? Part A, you are required to determine the premium, right. So, ICL is acquiring SVL and SVL current price is there, no, current market price is 75 rupees per share and they have given the share count also. So we know the current market cap, or we know the current market cap. Now what are they saying? You are required to determine the premium over the current market cap, which can be paid using net worth adjusted for current value of land and buildings plus estimated profits after 5 years. So basically you are first required to compute net worth, then you are required to compute average profits after 5 years. Here one point of difference what I have with respect to the institute solution is that they have given that SVL is expected to grow at 18% over the next 5 years. So do you think when you say average profit for next 5 years, we should consider that 18%? Correct, right? Logical, right? They have said that SVL is expected to grow 18% next year, and SVL has grown at 15% over the last 5 years, right? Has grown. They have not said how much period, but over last few years it has grown by 15%. ICL has been growing at 18. SVL, that is the target company, has been growing at 15. Post merger, the target company will also grow at 18. Right. Now, when you have a merger negotiation, if you remember, whatever synergies are there, everybody will ask for some amount of synergy. Right. Both the parties will say, no, our synergy belongs to me, no, synergy belongs to me. They both will negotiate. Right. Here, they have taken an assumption that all the synergies are of the acquirer only. That is, there is additional growth in the target company, and that growth is completely going to be, taken over, or that is growth is completely belongs to, that is the right word, the entire growth belongs only to the acquirer. The target company will no, that is not the case. There are some synergies coming. I also want some share of synergy. So, and especially given the fact that they themselves have mentioned that SVL is expected to grow at 18%, then I don't think, we should consider the old growth rate of 15%. That is what they have done in the solution in the suggested answers. That is, they have considered the old growth rate, assuming that the entire, synergy arising out of extra growth of the target post the acquisition belongs to the acquirer, which I don't think is a fair assumption. Okay, so what I would do is, if it is expected to grow at 18%, you will have to necessarily value that particular company using that expected growth, because boss, just like you have information, other party also has information. Okay, just don't think that the other party, the target, is a blind person or a dumb person. Please don't make such kind of assumptions. Right, targets are actually more intelligent than the acquirers. Okay, we have seen 90% of acquisitions fail. Why? I told you also that most of the people believe that they paid excess. That means what? That is that the target has taken more money, or the target has valued or has taken a greater portion of synergies. Right. So, we shouldn't make assumptions where we say that the target is, not getting any share in the synergy. Especially if you look at the suggested answer solution, they have not even stated the assumption. They have directly assumed that 15%. And even if you see the future value, they have given 15% future value interest factor, that is basically the cumulative future value for only 15%. Right. Ideally, you should do it for 18 also. Boss, everybody has calculator. Do you think that computation of future value for 18% is such a tough thing? Right. So, I don't agree with that particular logic. Anyway, I will show both the cases, but I believe that 18% is the right way to compute the value of the target rather than 15%, which is, basically thinking that the target is not smart enough. Right. Anyway, I will tell you that thing, but first let us, first begin with net worth. Part A, net worth. Net worth of SVL. Net worth of SVL. First, what have they said? Net worth of SVL. We have net assets value, right? Net assets already is given, and I'll call it as rupees crores, rupees CR. Right, that is a heading. All the amounts are in rupees crores only, no? So, book value of assets is how much? 890 crores. Then, of this land and building is how much? 190 crores. Okay, and they have said that land and buildings needs to be brought to current value, and SVL's land and buildings, there was a revaluation 3 years ago. After that, there is no change in land and buildings, and after that, every year there is a 30% increase. Then increase in value of, or revised value of land and buildings after 30% YOY increase, which is 190 into 1.3 into 1.3 into 1.3, right? Basically 417.43. Wow, it's a huge number, right? They have not mentioned whether it's a simple increase or is a CAGR increase, or nothing has been mentioned. They have just said, it has grown by 30%, right? So 190 only, no, land and building. Yeah, it is 190 only. So revised value of land and building after 30% increase is this much. So increase in value of land and building is how much? 417.43 minus 190, which is basically 227.43 crores. Okay, so revise or rather adjusted net worth is how much? This book value of assets plus increase in value of land and building is adjusted net worth 1117.43. Okay, let me highlight that. That is the first aspect, and all of this is in crores. I already told you, right? So adjusted net worth is so much. Then what is the second part? They are saying net worth adjusted for current value of land building plus the estimated average profit after tax for the next 5 years. See, one more point before I go to estimated average profit. Some of you might think, no, on buildings there is depreciation. The depreciation should have been adjusted, and after adjustment, then we should take the increase in value. You are 100% right. On land there is no depreciation, but on buildings there is depreciation. But the data is not available to us. So we are assuming that the land and building value that is given does not have any specific depreciation, and we can directly, this is the same value as it was appearing in the books 3 years ago. Okay, so if you want, I will actually write an assumption. Land and building book value of rupees 190 crores is same as what it was 3 years ago, and no depreciation, additions, deletions, where or slash are made to it in last 3 years. Okay, this is an assumption. Now first part is over. Now coming to the second part, estimated average profit for the next 5 years. See, PAT for current year. How much? What is the PAT for current year? They themselves have given some number. No, where is the PAT? 250. 250. Okay, everything again, this also in rupees crores. Now what are they saying? This PAT will grow at what rate? They have given future value of 15% and 30%, right? But this PAT is expected to grow at 18% per annum. PAT has grown at 15% per annum in the past. Okay, so what I will do is, I will compute future values for both of them, and we will solve this particular thing using both the alternatives, because I don't agree with the institute's solution that we have to consider 15% as the growth rate. I have just explained you the reason also. I will not go into the reason again. Okay, future value interest factor 15%, or first I will do 18% for 5 years, because they said average profit for the next 5 years, right? So this will be, let us say first year, it is year 0, right? I'll working note, I'll actually give a working note 1, year future value factor, year 0 it is 1, year 1 it is 1 into 1.18. right? This is for year future value factor at 18%. Then year 2, 1.18 into 1.18, right? Year 3, year 4, I'll actually minimize these additional columns. Okay, so year 3 is previous year value into 1.18. You can do this on your calculator also. You can do simply GT. Okay, you are all aware of how this has to be done. I will not go into all of that again. Then future value interest factor for 5 years at 15%. So this is summation of all this, which is 8.44. Now do you add even this 1 or you don't add this 1? Right, so okay, now do you add this 1 or do you not consider this one? You do not consider this one because you are computing the future value. Okay, so you're not computing including the current year number, you're only including from next year's number. Okay, year 0 number is not relevant. So future value is 8.4420. Okay, PAT is expected to grow at this rate, then it is the future value interest factor is 8.442. Same way, future value interest factor at 15% for 5 years, this they themselves have given. Okay, what is this number? 7.7537. 7.7537. Right. So, cumulative profits, okay, at 18%, cumulative profits for next 5 years, okay, at 18% and at 15%. So, is simply a multiplication of 250, which is current year profit, into 8.442 will give you next 5 years profit. This is cumulative profit, and you multiply the same 250 into 7.7537, you will get for the 15% growth rate, what is the profit. So, then average profit. What is average profit? I will copy the same thing. At 18% and at 15% is, you would simply divide by 5 because this is for 5 years, no? So, you get 422 and 387.69, right? So you've got these data points. Now, adjusted net worth is already available at 1117.43, then adjusted net worth plus average future PAT at 18% is 422 plus 1117, right? And in the second case, at 15%, it is 387 plus 1117. Okay, so this is the value of the company. This is the entire value of the entire company, right? Now, based on this, can we find out value per share? That can also be found out. You can do the premium computation either based on overall market value or based on the price per share also. You can make the premium computation based on the overall market value of the company or based on price per share. So, what is the share count? They have given paid up share capital is 125 crores with 10 rupees share. So, paid up share capital in rupees crores is 125. Face value per share is 10. Share count is 125 by 10, which basically is 12.5 crores. Okay. Then price per share. Okay, so here friends, there is one small error what I have done. Okay, I have just realized it as I was going through. This is not 1117. This is not net worth. This is the total value of assets. There is also a borrowing, no? I didn't subtract the value of borrowing. See, there is borrowing of 105. I have not subtracted the value of borrowing of 105, and I have directly taken the total value of assets as net worth. See, this is the mistake. These are the kind of mistakes that you should not do. Less borrowings. What is borrowings value? Minus 105. So, for me, because it is Excel, it is very simple. For me, because it is Excel, it is very simple to make the change. But for you guys, if you have not caught this when you are actually solving, then you are in trouble, right? So, even I, when I am writing the exam, if I have not got this small point, no, I also would have been in trouble, right? But thankfully, I have managed to, have a look at it, right? So, which is why you need to be slightly more aware of what you are doing. Okay, so adjusted net worth has changed, because of which all the other numbers also have changed. So, price per share considered at 18% PAT growth and price per share considered at 15% PAT growth is how much? You divide whatever adjusted net worth plus future PAT divided by 12.5 shares, crore shares, you will get one number which is 114. And the second one for 15%, you divide 1400 crores is the adjusted net worth plus average future PAT at 15%, divide by 12.5 crore shares, you will get 112.01, right? And what is the current market price? Current market price in rupees. What is the current market price? They themselves have given us 75. So, instead of here these two, I'll just copy and paste them again. Premium per share at 18% PAT and premium per share considered at 15% PAT growth. They both will be how much? 114.76 divided by 75 minus 1, which is 53%. I'll slightly increase the decimals, 53.02. In the second case, 112 divided by 75 minus 1. Yeah, so it will be 49.35%. Okay, so these are the premium per share values. Now we have completed the first part. Now let us go to the second part. So friends, let us come to part B or part 2. I don't know if it is 2. I think we can put it as 2 or B, doesn't matter. The important thing is substance over form. Okay. Dividend growth formula. Now you have to compute the value of this particular share using dividend growth formula. What is dividend growth formula? D1 by KE minus G. Right, that gives you the price. Now here, what will you take G as? We should take 18% only, no? Right, because that is the expected growth. There also you should not take 15%. Right, so I believe there also you should take 18% only. Okay, then how will you find out KE? Will you find out KE? KE can be used, see, KE has to be computed based on the fact that this details of this merger are not available or not known to the public. They are not known to the public. The price is not accounting for the potential future increase in earnings. Hence, the price of the share in the market is only factoring in a growth rate for SVL of 15%. Right. So, you have to work backwards. What is the formula? P0 is equal to D1 divided by KE minus G. Okay. So, current P0 is what? P0 is 75. P0 is 75. What is D1? See, now the data that they have given, the summarized profit and loss account of both the companies. Now, the summarized profit and loss is current year, past year, what year, no information is given. Right. So, if you look at this, right, I would tend to think that this is past. I would definitely tend to think that this is past. Right. I would not make an assumption that this is future. Okay. So, what I will say is D0, right, total rupees crores, okay, is how much? 125. Okay. Share count is how much? In crores. We already just computed in the previous part of the question, 12.5. Right. So, D0 per share is how much? 125 by 12.5, which is 10. This is in rupees. Now, what G are we supposed to take? Are we supposed to, I just explained to you whether we are supposed to consider 15% or 18%. So, we just discussed whether we are supposed to take an assumption of 15 or 18. I said future will be based on 18. Current market price only accounts for the fact that it is 15. Why is that important for us? Using that, we will arrive at KE. So, G for current market price is 15%. So, D1 per share in rupees is 10 into 1 plus 15, which is 1.15. Right. Now, KE is what? We have the formula, right, which is basically D1 by P0 plus G. D1 divided by P0 plus G. Right. So, KE is D1 11.5 divided by P0, which is 75 plus G, which is what is the growth rate, which is 15%. So, it comes to 30.33. It comes to 30.33%. Right. So, cost of equity is 30.33%. Does it not sound too much? Obviously, you know, when your growth rate is 15%, then cost of equity will be like that only. Your growth rate itself is 15%, no? So, you're directly adding G, that itself is a 15% number. And what is your dividend? Dividend is out of your share price, 11.5 rupees is the dividend value. So, obviously, it will be a fairly high number. Right. So, cost of equity we have found out. Now, P0. Now, what is it? What is the specific question that they asked? Dividend growth formula. Value of SVL based on revised growth. So, friends, you see here, when you based on revised growth, what is it you're computing? You're computing is using 18%, correct? 18% is the growth rate. Okay. I'll tell you one simple logic, why I believe that in the part A, we should consider 18% and not 15%. When it comes to dividend growth model, you are valuing the company based on future potential growth, correct? And you are taking it as 18%. If you were to, let's say, consider as 50%, do you need to even compute the value of SVL based on dividend growth model? No, you can directly say, no, that 15% is the growth rate. So 15% is what is current market price reflecting. So the price is 75. I don't know if you got my point. If you consider that the future growth rate is only 15% and not 18%, like what they have given in part A for in the suggested answer for in the material or suggested answer for this particular question, right, then even in this part, future growth should be only 15%. If it is 15%, what is the need for doing all of this activity? I may directly say that the dividend growth model price is 75. Why? Because this dividend growth model considers inherent, in it the inherent growth is 15%, which is the past. Right. So, when you are going to take 18% in part B for future growth, you should take 18% in part A also for future growth. That is my belief and my logic. Anyway, KE is how much? 30.33. D0 is how much? We have done it as 10 rupees. Then G is 18%. So, D1 is 10 into 1 plus 18%, which is 11.8. Then P0 is equal to D1 by KE minus G, which comes to, what is D1? 11.8 divided by KE. What is cost of equity? 30.33 minus G. What is G? 18%. So the value comes to 95 rupees per share, 95.6. And this is, I'll write in rupees. Right. Now, current market price is how much? 75. If you are going to consider 75, if you are going to consider 15% as a future growth rate, then current market price will be same as the dividend growth model price and the premium will be 0. No? There is no point of even solving all of this. Current market price in rupees. Right. Premium of DDM based valuation over current market price is 95.68 divided by 75 minus 1, which is 27.57%. Okay. So, this is the answer for part B of this particular question, which is what is the premium over, what is the premium if the valuation is made on dividend discount model over the current market price? It is 27.57%. Now, what is part C? Part C. ICL will push forward which method during the course of negotiation? ICL, which is the acquirer, will be more interested in giving as little premium as possible. So, as premium over current market price is lower in case of dividend growth model, dividend discount, dividend growth, both mean same, don't bother about it. In DGM model based valuation, ICL will push for second method during negotiations. Okay, that's all is part C. Okay. Interesting question. I think we've solved one question which is slightly similar. I don't think exact same to same we have not solved, right? So, but I think some problem, if I'm not wrong, we solved something very close. But anyway, nevertheless, we've solved this. It's a fairly good question if you ask me, except for the fact that, you know, the institute suggested answer goofed up here. They should consider PAT growth at 18% even when you do a, you know, in part A where you are computing the average future profits. Okay, fair enough. Let us move to the next problem. So, friends, let us look at the next question. Given the following information of two companies, Day Limited and Night Limited, 5 crores and 3.5 crores, and what is this? 10 lakhs and 7 lakhs of equity shares. The shares of Day and Night trade at 20 and 15 times their respective PE ratios. Okay, Day considers taking over Night by paying 55 crores, considering the market price of Night reflects its true value. So the market price is reflecting full value, but then you want to pay 55. What is the market price? We don't know. Let us see. We will figure that out. Okay, it is considering both the options, takeover funded by cash, takeover funded by stock. You are required to calculate the cost of takeover and advise Day Limited on the best alternative. Okay, this is from May 19 new syllabus. Interesting question. It's a very interesting question. There may be one or two small twists. Let us see. Once we start solving, I think we will hit one or two places where we have to take assumptions. So, we will write those assumptions out. Okay. Fair enough. Let us go ahead and solve this problem. Okay, friends, let's start off the solution. Particulars, Day Limited, Night Limited, and combined Okay, what is PAT in crores, in rupees crores? In rupees crores is 5 crores and 3.5 crores. Okay, the combined PAT, they have not given any synergy value, should be 8.5 crores. Okay, then share count in this also I will give it in crores actually. They've given it in lakh, they've given it actually the values are in lakhs, 10 lakhs and 7 lakhs. I'll put it in crores so that it is easy for me to divide. 0.1 crores and 0.07 crores. Okay, so PAT by share count will give you EPS. Right, EPS in rupees. What is EPS? 5 by 0.1 is 50, 30, so 3.5, 3.5 by 0.07 is also 50. Oh, EPS is common for both. Very good. EPS is common for both. Then PE ratio 20 and 15. Days 20, this is 15. So market price in rupees is 50 into 20, which is 1000, and here it is 750, and market cap in rupees crores is basically your market price per share into share count. So here it is 100 crores and here it is 52.5 crores. So we now got the value 52.5. Now what is it that they are saying? Day Limited considers taking over Knight by paying price of rupees 55 crores. Right? Purchase consideration in rupees crores. This is how much? 55. So if you want, I'll actually write here what is the market cap. Is market price into share count. Right? And market price is PE into EPS. And PE they've already given, EPS is PAT by share count. Okay. Purchase consideration in crores is 55. Now, what are they saying? What is the considering market price dual? It is considering both the options. Takeover is funded by cash or takeover is funded by stock. Are required to calculate the cost of takeover and advise Day Limited on the best alternative. Okay. Cost of takeover. What is the cost of takeover? See, you are there something that is worth 52 and a half. You are paying 55. Right. Cost of takeover in rupees crores. Okay, cost of takeover or net cost of takeover in rupees crores. See, if you look at some of the previous problems that we solved, there they have given that, post the merger, something is going to happen to the target, there is going to be an increase in value and all of that. At that point of time, we subtracted the revised value of the target, that is, or the post-merger value of the target from the price that was paid. That is, you pay something, you got something in return. Your price is what you pay, value is what you get in return, right? So we subtracted price minus value, what we got, and said if the price is higher, then there is cost. Price is lower, then there is no cost, it is benefit, right? Here, there is no change in the financial position or rather the profitability of the target post the acquisition. There is no change. So we can directly consider the market price or the market value of the entire sharehold or the entire shares of the, so we can directly consider the market cap of the target or the market value of all the shares of the target as the, the cost of what you are actually acquiring, whereas the price what you have paid is 55 crores, whereas what you are getting in return is 52 and a half. So net cost of takeover, we should not call it as net cost of takeover in rupees crores, is price paid minus value received, right, which is 55 minus 52.5. So net cost of takeover in crores is 55 minus 52.5, which is 2.5 crores. So if the takeover is funded entirely by cash, this is the story. Okay, purchase consideration in rupees crores when paid in cash. Now, if you are funding entirely by stock, right, if you are paying entirely by stock, purchase consideration in rupees crores is 55, price per share of Day Limited in rupees is how much? 1000 rupees, right? Shares issued in Day Limited in exchange for acquiring the business of Knight Limited is 5 crores is rupees 55 crores divided by rupees 1000 per share. So, number of shares issued, it will be is equal to 55 crores, 7 zeros, 1, 2, 3, 4, 5, 6, 7 divided by 1000. So, that will get you 5,50,000 shares. That will give you 5,50,000 shares are issued. Now, if 5,50,000 shares are issued, what is the cost? So, this is where I think we have to make an assumption. See, what is the value of the combined entity, assuming that the market caps get added? If you assume that the market caps directly get added, then the value of the entity is 152.5, right? However, there is another way, and we have seen this earlier also. If the PE of the acquirer remains the same, then the overall value accretion is much higher. Correct? Then the overall value accretion is much higher. In that case, the overall market cap will not be 152.5. So, here we will say, we will make two assumptions. In case overall, or in case combined market cap remains same as pre-merger, then post-merger market cap of combined entity is how much? 152.5 crores is 152.5 crores. Then share count of Day Limited, shares issued to Knight shareholders, total share count post merger. What is share count of Day Limited? Is 0.1 crores. So, this is basically 10 lakhs. 1, 2, 3, 4, 5, 6. Then to Knight Limited, you issued 5,55,000. So, the total share count is 10 lakhs plus 5,50,000, which is 15,50,000. Right, 15,50,000. Now, 15,50,000 is the total share count. Post merger value of stake held by, or rather stake held by shareholders Knight post merger is 5.5 lakhs divided by 15.5 lakhs. How did I get that? 5.5 here and 15.5 here, which is how much? 35.48%, right? So, market value of stake held by shareholders of Knight post merger in rupees crores is how much? 35.48% into 152.5 crores. So, basically their market value is 54.11 crores, right? Market value of stake held by, or market value of Knight pre-merger is how much? We just have the data here, no? Is 52.5, right? And purchase consideration in rupees crores is how much? Is 55, right? Is 55 crores. Now, you see these three numbers. What are the relevant numbers? What is the value that you have given, or what is the price that you have paid versus what is the value that you have received? What is the price paid? Price paid is 55. What is it that you have received, or what is the value of the stake that you have given up is 54.11. So, actually this 52.5 is not relevant, right? So, price paid minus value received is cost of, is net cost of acquisition. That is 55 crores minus 54.11 crores. So, what is the price paid value minus value received, which is the net cost of acquisition, which is your 55 minus 54.11, which works to 0.89. So, let me increase the decimal. is 0.887 crores, right, in rupees crores. So, the net cost of acquisition here is 0.887, that is you have paid 55, but the other party has actually got something only worth 54.11. So, or rather the value of the stake held by the other party is 54.11. Now, whereas in the previous case, what was it? When you did the takeover by cash, you paid 55 for something that is worth only 52.5. So, there the cost of takeover is 2.5. Here, you paid something 55 and the other party is got value out of it, or rather the overall stake of the held by the other party is valued at 54.11. So, the excess that you have paid is only 0.887. So, what you will write is, given that the net cost of acquisition is lower in case of stock swap, that is the word they have used, right? What is the word? Specific word. In case the takeover is funded by stock, it is better to go, or it is better to fund the takeover through that. Right. So, friends, now we looked at the case where the market cap of the post-merger market cap of Day Limited is simply the combined market cap of both the entities, right. But if you remember, and I am highlighting this purposely, if you remember, I said that there could also be a scenario where the PE ratio remains the same and the post-merger market cap actually changes, right. It is not the same as pre-merger market cap because both the entities have different PE ratios. Now, in this scenario, the acquirer has a higher PE ratio than the target, right. So, if we assume that the higher PE ratio continues, that is acquirer pre-merger PE is taken as what? 20, right. 20 is the number if I am not wrong, right. Yeah, 20. Then, what is the overall share count? What is the share count? Share count is, we have already computed in the previous case. Here, we have got 15.5 lakhs, right. 15.5 lakhs is the share count, correct? Right. Now, what is the post-merger PAT? What is the post-merger PAT? I think that also we have computed somewhere, or if it is not there, we can actually compute. It is already here, 8.5 crores, right. Post-merger PAT is 8.5 crores and the share count is 15.5 lakhs and acquired pre-merger P is 20. So, post-merger PE is also assumed at 20, then post-merger market cap. Let me write here the currency also in rupees crores, share count in numbers, right. So, what is the post-merger market cap? See, you can do either EPS multiplied by PE ratio, then multiply the whole thing by share count, or you can directly multiply the PAT with the PE ratio. So, here it will be PAT with the PE ratio is 8.5 into 20 is 8.5 into 20, which is 170 crores. So, post-merger market cap is 170 crores. Now, this is post-merger market cap, but what is the stake of Knight Limited in Day Limited, or rather Knight Limited shareholders? We already computed it earlier, which is what? 34.58%. 34.58%. So, what is the value derived by shareholders of Knight Limited? Value derived by shareholders of Knight Limited is total market cap into Knight stake, right. So, which is 35.48% into 170 crores, which works to, in rupees crores, 60.32 crores. Now, you see how different this is from the previous working that we made. Previously, we got market value of stake held by shareholders of Knight post merger as 54.11. So, I am highlighting this just so that you understand, right. And now, suddenly, because we are assuming that the PE ratio of Day Limited pre-merger will continue to be same even post-merger at 20 times, then the value derived by these guys Knight is, or the value of the entire stake held by shareholders of Knight is 60.32 crores. So it has gone up from 54 to 60. So on the face of it, it looks negative for Day Limited, that is acquirer Day Limited. See, right, value or price paid to shareholders of Day Limited. Shareholders of Knight Limited, I am sorry, shareholders of Knight Limited. What is it? You gave shares which are worth 55 crores, which is basically the purchase consideration, but value derived by shareholders of Knight Limited is how much? Is 60.32 crores. So, what is the cost of merger? Is the difference between these two. That is, what is the price that you have paid versus value derived. So, they have derived more value. So, for you, you have given away extra. You have given away extra. How much have you given away extra? 60 minus 55, that is 5.32 crores. Cost of merger in rupees crores is 5.32. So, the cost of merger here comes to 5.32 friends. Now, you see there is one point I wish to highlight, actually 2 points are there which I wish to highlight. The first point is, in the previous two cases when you were doing by cash, right, when you did by cash, what is the number that you got? Where is that number? 2.5. 55 minus 52.5, that is what you paid is 55, what those people, other people derived is only 52. So, basically 2.5 is the difference. Right, so we call that as cost of takeover. And in the second case, you paid 55, the other party derived only or got only 54, so you got a difference of 0.88. So both the cases, 55 is the first one, from that you are subtracting the value derived by the other party, and you have got a positive number. But when you come here, you actually do 55 minus 60, you are getting a negative number. Right, that is, you have paid 55, but the other party has derived much more. So if you honestly see in this, you have given away a lot more, or rather in this you've given the other, for whatever price that you have paid, you have allotted shares and the other party has actually made a gain out of those shares. So honestly, if you see, this is the cost of merger. In the other two cases, if you see, you know the first one where you paid by cash, you paid 55, whereas the other party derived value to the extent of only 52.5, whereas in the full stock, whereas if you were to exchange it, the shares of Day Limited for the shares of Knight Limited, the purchase consideration was 55, but the value of the shares that are held by shareholders of Knight was only 54. Right. So there is a slight difference in the way you look at this particular aspect. So here, if you are going to show this as positive number 0.887 and 2.5 as positive, then here 5.32 has to be necessarily shown as negative. Why? Because you gave them shares worth 55, but they got value more than 55, right? And this is the first aspect that I want to highlight to you. The second aspect what I want to highlight to you specifically in this is it correct way of actually calculating the cost of merger? I mean, in the sense that 55 minus 60.32, is it even correct? Honestly, if you ask me, I don't think it is even correct. Why? I'll tell you why. See, what is the increment or what is the market cap of shares held by Day Limited pre-merger? In rupees crores. What is the thing here? We already know the number, it is 1000. Right. Now, post-merger, because that the EPS, overall EPS is going up, and because the PE ratio continues to remain as pre-merger PE ratio, which is higher than that of the target, right? Post-merger market cap of Day Limited is how much? Is 170 crores into 1 minus 35.48%, right? Or if you want, I will do it other way, which is stake in company post-merger. Stake in company post-merger is 1 minus 35.48%. This is correct, no? See, you have 10 lakh shares out of 15.5. So, even if you do 10 by 15.5 or you do 1 minus 5.5 by 15.5, answer is same, which is 65.42. Right. So, if you post-merger market cap of shareholders or post merger value of shares of shareholders of Day Limited is how much? Multiply the same thing, right? This 170, which is the post merger market cap, multiplied by 64.52, you will get same 109. So initially they had 100, now it has grown to 109, right? Now it has grown to 109. Now what is this whole cost about? Arey boss, initially you had 100, post merger, even though there is a dilution, the value of your stake has gone up to 109. So where is the true cost of merger? So actually, if you ask me, right, this is a very unfortunate and unfair way of asking questions by ICI. I actually don't subscribe to this whole thing of what is the true cost of merger. If at all this question comes, I would want you guys to at least give these 3 data points. One is if it is paid by cash, price paid minus value received by the target. This is one way. If it is paid by stock and you ignore the PE aspect and consider that the post-merger market cap is summation of pre-merger market caps, then also you do purchase consideration minus the value received by the other party. And if it is run with respect to PE of the acquirer being same pre-merger and post-merger, then the overall market cap of the entity post-merger increases, in which case, honestly, if you ask me, there is no cost because, for everybody there is a gain. The gains are being split between the acquirer and the target. But if at all you want to compute something, what is the price paid to shareholders of target minus what is the value received by them? So they will actually get 5 crores extra here, what we are seeing, minus 5.32. So these 3 numbers is what I want you to compute, right? But also please note, I fundamentally disagree with this whole working, okay? I mean, in the sense it is conceptually, I don't find it correct. Right, because when there is both the parties are making a gain, how will you say that for one of them there is a cost, for the other there is no cost, right? So that is why I have a slight difference of opinion. But if in the exam, what I would want you to do, I have clearly explained. You talk about this 2.5 if it is cash, you talk about this 0.887 if it is by stock, and when there is when the PE is completely ignored, and then you talk about this 5.32 if the PE of pre and post merger of that acquirer continues to remain the same. Okay, so this is the answer to this question. Fair enough. Let us move to the next one. So friends, let us look at the next question. This is a buyback question. I think we have solved something very similar in probably I think security valuation chapter. But I think we should solve it once again, just so that you are aware of a problem like this even in this chapter, because buyback is part of this chapter. Okay, so let's have a look at the question. ABB Limited has a surplus cash balance of 180 lakhs and wants to distribute 50% of it to equity shareholders. Okay, the company decides to buy back equity shares, and the company estimates that the equity share price after repurchase is likely to be 15% above the buyback price if the buyback route is taken. Other information is as under. Number of equity shares outstanding at present is 20 lakh rupees with face value of 10 rupees each, that is 2 lakh shares, and current EPS is 5. You are required to calculate the following. 1. The price at which the equity shares can be repurchased if the market capitalization of the company should be rupees 400 lakhs after buyback. This is May 19 new syllabus question. See, for me to explain this question, right, I think actually we should put numbers in the start working out by putting the numbers first. I think that is when we will be able to understand this, because me explaining this kind of questions by hand waving is slightly tough. Okay, so let us go ahead and put the numbers, and then I will, as we move along, I'll explain the solution. In fact, this, if you have already come till here, with respect to SFM, I think this question you should actually solve it on your own. There is nothing fancy in this question. I just want to do it so that I want to complete that one particular aspect called buyback in this chapter also. So that we have finished buyback specific problems in this chapter also. I want to actually tick it off. That's all. If you have finished all the chapters prior to this, then I don't think there's any complex problem. It's a fairly simple problem. Let's go ahead and solve it. So friends, before we solve this particular question, there are 2 more small parts in the question which I think I forgot reading. Not only did they ask at what price will the equity shares can be repurchased if market capitalization of the company should be 400 lakhs after buyback, they also added 2 more parts. Number of equity shares that can be repurchased and the impact of equity shares repurchase on EPS assuming that net income remains unchanged. Particulars, then amounts. I'll just say amount. Okay. Count in numbers. Somewhere you have numbers also, no? That is number of shares and all that. Okay. So first let us write down the data that they have given. surplus cash in rupees lakhs is how much? 180. Buyback distribution percentage is 50%. Buyback distribution in rupees lakhs is 50% of 180, which is 90 lakhs. Then what did they say? The company decided to buy back shares. Company estimates that equity share price after repurchase is likely to be 15%. Have they given the current price? No, they have not given. Okay, let us come back to this. The number of equity shares at present. Number of equity shares at present is how much? In lakhs is 20 lakhs. So here I think they gave the amount as rupees 20 lakhs. Here the share count is 20 lakhs, not the share value. Okay, the number of equity shares in lakhs is 20 lakhs and face value per share in rupees is how much? 10. So total share capital in rupees lakhs is product of these two. 20 lakhs into 10 rupees is 200 lakhs. Then what have they given? Current EPS in rupees is 5. Then if you have EPS and you have the number of equity shares, you can find out the PAT in rupees lakhs, that is equal to EPS into share count, which is EPS of 5 into share count of so much, which is 100 lakhs. Then what else have they given? You are required to calculate the following. The price at which equity shares can be repurchased if the market cap of the company should be 400 lakhs after buyback. Right. Post buyback market cap in rupees lakhs is 400 lakhs. And what is the other information that I have given? Company estimates that equity share price after repurchase will be 15% above the buyback price. Have they given the buyback price? No. Have they given the PE ratio? No. So we don't even know what the current price is. See, because they have given EPS, if you multiply it with the current PE ratio, you will probably get the current market price, but that is also not there. Right. So we have to assume current market price in rupees is P, post buyback market price in rupees is 1.15 P. Why 1.15? Because post the buyback, the market price is expected to go up. Now, we have this information. They are asking the price at which the equity shares can be repurchased. So, this P is what they are asking us to find out. But how will you find out P? They have not given any information on, see, they have given information only to the extent that 90 lakh shares are bought back. 90 lakh worth shares are bought back. But how many shares are bought back is not known. But what they have given is post the buyback, the market capitalization is 400 lakhs. So, what we can do is current market cap in rupees lakhs is share count into market price, correct? What is this? What is the current share count? Share count is 20 lakhs shares into current market price is P, correct? So, this is current market cap. What is future market, post buyback market cap? Post buyback market cap is how much? Post buyback shares into post buyback market price, right? Now, this also is in rupees lakhs, by the way, and they themselves have said that this is 400 lakhs. Post buyback market cap is 400 lakhs. So, what is the post buyback shares? See, we currently have existing shares of 20 lakhs, right? How many shares are you going to buy back? We are going to buy back so many shares which will give us the, which are equivalent to 90 lakhs value, right, at current market price. So, actually, before I do this, let me add couple of more rows. What is post buyback share count in lakhs? Pre buyback share count minus shares bought back, correct? So, if you were to further simplify this, what is pre buyback share count? That we very clearly know is 20 lakh shares, 20 lakh shares minus how many shares are bought back? We don't know the shares, we only know the total value of buyback. What is the value of buyback? Value of buyback is 90 lakhs. and value of buyback divided by the price at which it is bought back will give you the number of shares that have been bought back. So here minus 90 lakhs rupees, minus rupees 90 lakhs divided by the price at which it is bought back, which is P. Right, P is the buyback price. So if you do this, 20 lakh shares minus 90 lakh rupees by P, P is basically in rupees only, okay. So I'll just say rupees P, you will basically get number of shares that are bought back. Now, post buyback share count is, this is what is the post buyback share count. Now, what is post buyback market cap? Post buyback market cap is, they themselves have given us rupees 400 lakhs. So you can actually equate these two equations, which is this, I'll just highlight it with this. Okay, you can actually equate, and this you can equate after slightly more simplifying this post buyback market cap formula further, right, which is, so I will, let me show this to you, rupees 400 lakhs is equal to post buyback shares into post buyback market price. This is correct, so far so good. Now further simplifying this, what is post buyback share count? We just computed here, no, 20 lakh shares minus rupees 90 lakhs by rupees P, right. So this, okay, this is one part of the equation, and you have to multiply this with what? Post buyback market price. What is post buyback market price? We already know it, no, it is 1.15 P. Acha, so this is into rupees 1.15 P. 20 lakhs minus rupees 90 lakhs by rupees P into rupees 1.15 P. This is equivalent to 400 lakhs. Now, if you solve this equation, you will get the value of P. What is the value of P that you will get? Let me see. 20 lakhs minus rupees 90 lakhs by P. So, P you cross multiply. So, what it will happen is rupees P into 20 lakh shares minus rupees 90 lakhs divided by P and into rupees 1.15 P divided by P rupees, okay. I am just simplifying the equation, I am not doing anything fancy, okay. So, if further solve this, divided by P into P, so that P will get cancelled and it will be into 1.15. So, this will become P into 20 lakhs shares minus rupees 90 lakhs into 1.15 P. So, if you were to simplify this, what you would have got is to 1.15, P will go away, right. P in the denominator and P in the numerator get cancelled. So, rupees P into 20 lakhs shares minus rupees 90 lakhs into 1.15. This is the right hand side of the equation. So, you further solve this, rupees 400 lakhs divided by 1.15 is equal to rupees P into 20 lakhs minus rupees 90 lakhs. So, rupees P into 20 lakhs minus rupees 90 lakhs is the right hand side, right. So, now if you simplify this, 400 by 1.15, that is 347.82, this is in rupees lakhs, okay, is equal to P into 20 lakhs minus rupees 90 lakhs. So, if you add, bring 90 lakhs to the left hand side, so 347.82 plus 90, this is in rupees lakhs, is equal to rupees P into 20 lakhs, right. So, if you were to solve for P, 437.82 lakh rupees divided by 20 lakhs will basically give you 21.89 rupees is equal to value of P. Okay, if you were to solve this. So, I will just add a small column here and write what this pertains to. These are rupees lakhs, these three are rupees lakhs, so, and this is rupees. So, 21.89, so I am just reducing the decimal so that it is clear. 21.89 rupees is equal to rupees P. So, P value is 21.89. Now, is that the first question that they have asked? The first question that they have asked is the price at which equity shares should be repurchased. We have got the answer for the first part. Now, come to part 2. What is part 2? Number of equity shares that can be repurchased. It is very simple. Number of equity shares that can be repurchased is total buyback value divided by price per share, which is rupees 90 lakhs, because that is the buyback value. We said first they had surplus of 180 lakhs, of which 50% is spent on buyback and all that, right? So 90 lakhs divided by 21.89 rupees. Okay, so number of shares that can be bought back is equal to 90, 1, 2, 3, 4, 5 divided by 21.89, which is 4,111,46.64. So I will round it off. Round off bought back is how much? 411,147. Okay, those are the number of shares that are bought back. Now what is the next part of the question? The impact of equity shares repurchased on the EPS, assuming that the net income remains unchanged. Now part 3, pre-buyback and post-buyback, PAT is same. PAT pre and post-buyback is how much? We've already computed it. It is ready-made available here. Where is the PAT? 100 lakhs. Right, 100 lakhs. This is in rupees lakhs. Post-buyback share count, which is 20 lakhs minus 411,147. Right, 20 lakhs is the original share count. That is what we wrote, right? Number of equity shares in lakhs is 20 lakhs. 20 lakhs minus shares that you bought back is 4,111,147. So the net number is 20, 1, 2, 3, 4, 5 minus 4,111,447. Right, 15 lakh 88,853. So post buyback EPS in rupees is equal to 100 lakhs, 1, 2, 3, 4, 5 divided by 1,588,853. That comes to 6.29. Then pre-buyback EPS in rupees is how much? 5 rupees, no? Yeah. So increase in EPS in rupees is 6.29 minus 5. Increase in EPS in percentage is 1.29 divided by 5, which is 25.87%. Okay, so these are the answer to the 3 questions that they have asked. Okay, part A, part B, part C. Have they asked anything else in this question? No, I don't think they have asked anything else in this question. I will give you enough tools to help you understand a lot of stuff. If you were to revise it frequently, you will remember the key points. We will give you some mnemonics. We will give you some ways to remember, but there is no need to mug up. I believe that we both together can work on all these 3 things: concepts, practical application and examination.